To be with you guys. All right, we've got slides. All right, so we just had a big event in New York, and what you're going to see me do here today is distill what was a full day's worth of content into a very short deck. So consider this my own test of a lightning talk. So who are we? I'm the CEO of Dromos Labs. Dromos Labs is the development company behind two of the largest exchanges on Ethereum, Velodrome on the superchain and Aerodrome on Base. Our core belief, right, the thing that animates us is that shared systems should create shared value. And so we are the builders of infrastructure that delivers back uncommon value to all the users of it. And our general thesis is probably not controversial. The world is coming on chain. And we think the best piece of evidence for this is just looking at the growth between the early internet and the on-chain economy. And you can see here that the on-chain economy is growing at an even faster pace. And Brian Armstrong recently predicted that over the next 5 years, 10% of global GDP will come on chain. And this would represent an order of magnitude increase over the size and scale of our industry today. And because it's the stable summit, I just want to show an example of why on-chain systems matter so much. So this is the rate that you can get on Wells Fargo, Chase, and even Wise, which is one of the best sort of traditional startups working on global payments. And right now, today, on Base, you can get a fee that is up to 300 times better on Aerodrome and Base, making this sort of transfer. And of course, because it's on-chain, the settlement time is virtually instant. So this is the promise of on-chain systems, and it's happening right now. Why do on-chain systems win? Well, they're just better. This is not something new. You don't have to be ideological about it, even though many of us are. This is just better technology. And we think the core thing that differentiates on-chain systems is that it allows you to basically distill the entirety of traditional firms into code, right? You don't need all these people. You don't need this whole coordination layer. We distill that down to code and you have a hyper-efficient system. But that means that there is a new competitive moat. There's only one moat in these new on-chain systems, and that is maximum value distribution to your users. And our thesis here is that any on-chain or any traditional firm, right, and these are all the businesses, companies, institutions you already know, that is heavy, weighty, and extracts value, or even any on-chain firm that extracts value out of the system will fall to a system that maximally captures and redistributes value to all of its users. So this is important to set up, but basically, we think the on-chain economy is a bit misunderstood. You'll see over here, this is the traditional structure of the economy. The economy we all know and maybe have mixed feelings about, but it's defined by macro structures. The governments establish the property rights, the things that sort of underlie all these markets. And the next layer up is the liquidity layer, because there is no economy without the ability to exchange all of this stuff for other stuff, right? So liquidity and macrostructures are the foundation of the traditional economy. That's what everything else is built on top of. And the on-chain economy is no different. There, the macrostructures are defined by the chains themselves. These are what establish consensus between participants. But without liquidity and liquidity networks, none of the other amazing, cool stuff we're building on-chain works. There is no on-chain economy. So a more concise way to say this is that the liquidity layer is as essential as the chain itself. It must be treated like an open network, just like chains are. So the evolution and history of DEXs is basically, they started as simple two-sided marketplaces, connecting traders and liquidity providers. And what we learned over the evolution is liquidity providers will just go wherever the reward is highest. So SushiSwap began this innovation. We're going to add a token here. It's going to become a three-sided economy. Curve made that token actually useful. It began to align incentives, kind of like you see at a network token level. But really, there's only one ultimate solution to this, right? DEXs are not two-sided marketplaces. They are three-sided economies, and they basically have to maximally solve for three stakeholders. Traders only care about one thing. They don't care about your DEX. They don't care about anything. They just want the best execution. Token operators need to be rewarded for coordinating the network, and liquidity providers want the best reward. So you have to do the best job for all three. And this is just to emphasize this. Gauntlet did a report, Uniswap commissioned it, and it basically said, look, if you cut rewards at all to liquidity providers, they leave. It becomes a death spiral, right? Less rewards means less liquidity, which means worse execution, which means less revenues, et cetera, et cetera. So this is why you have to maximally reward all three stakeholders.
Discovery is not found, it's felt.
So what have we been building? We call it the MetaDex. And it's basically an on-chain immutable framework. It treats the liquidity layer like you would treat a chain network. But more simply, we just call it a DEX operating system. So what is the MetaDex? It combined all the best primitives that came before into a single design. It maximally solves for all three stakeholders by one, capturing and distributing 100% of the revenue it creates. There's no leaks, no middlemen. It rewards only active participants. So it takes all that value, gives it to those providing active liquidity that traders need. And in doing so, it aligns the incentives of all three groups. How does it do that? Well, it pulls together multiple revenue streams, right? So all of the trading fees that happen on the DEX, liquidity payments, incentives on top of that, and things like launch payments that have traditionally gone to centralized exchanges. And it takes that wrapped value in the form of the token and injects it directly into the active ticket liquidity. So this is how MetaDexes are able to reward LPs, give the best execution, make more revenue, higher rewards, et cetera. You see the flywheel. And this is pretty crazy, right? We haven't seen something like this since the very advent of UniV3 liquidity. Anywhere a MetaDex competes with legacy DEXs, it wins about 3/4 of the overall market. It is totally dominant, and it does this by aligning those incentives. And just to emphasize it a little bit more, Aerodrome over the past year was the 5th highest revenue generating protocol in existence in DeFi. It is the top revenue generating DEX by a massive margin. But of course, we did follow the news about the fee switch on Uniswap, and we did some back testing and modeling based on the high end of the estimates. And even with the fee switch, the MetaDex would remain #1 today. So when we think about this, this is market opportunity meets right to win. We know the model works. We know it's only servicing right now about 1/5 of EVM volume. So what are we going to do? What happens when right to win meets an opportunity? Well, we just announced the newest version of our DEX model, and it is called Animation Building. There you go, MetaDex 03. So MetaDex 03 is the biggest jump forward we'd ever made on this model. MetaDex 02 is already dominant, and it's bringing Velodrome and Aerodrome together as a single exchange we call Arrow. Arrow will now, for the first time, extend this dominance that the MetaDex has onto mainnet Ethereum. It's also going to be launching on Circle's Arc, but the goal is very much to be the single liquidity layer for all of Ethereum. So how are we going to realize that? Well, we're going to treat it all as one liquidity network. We're going to abstract a bunch of stuff away. These are a bunch of the features that are in it. Won't have time to hit too much of them. But one key thing we've done is we've internalized even more value into the DEX model. And that is 2.8 times more. So this is already taking the leading model and the ability to reward liquidity providers and multiplying it. And we're able to drop the inflation in the new model by about 85%. So a lot more value coming into this model to reward operators, liquidity providers, a lot more leaving in terms of inflation. So this is like a huge, huge upgrade, bunch of charts illustrating it. But if you were a business and you said, hey, we're going to drop costs by this much, 85%, we're going to increase revenues, that would be a record-breaking quarter. So let's just show you real quick what this looks like and the problems it solves. Well, it begins with trading, continues with earning, and then launching. So let's just talk about trading. Trading sort of sucks today. Let's imagine you're looking for a token. You go to Uniswap on mainnet, put in the token address. You don't see it. Can't find it on the aggregator either. Let's keep going. Well, you found it. It's on Base. So you got to go over to a bridge. Which bridge do you use? Looking around, you finally get it over. Well, shit, you didn't actually bridge any gas, so you got to go back, do it again. All right, finally you're there, but you got killed by slippage. You missed it. So Arrow makes this or fixes this because we have fully abstracted bridging, swapping, and cross-chain aggregating all in one place. So if you see like a rudder on Base, but you only have gas on mainnet Ethereum, no problem. Everything's happening on the back end. All you see is a swap executed. So this is 3 levels of product all into one. Makes it super easy to integrate. We don't care about owning the front end. Some people make a business out of that. We want aggregators to plug into us, Coinbase to plug into us. If we talk about earning, it's the same problem, right? You want to lock some tokens, participate. You got to go to one product. Well,
there we go. I'm the global blockchain leader at EY. I'm also the chairman of the Enterprise Ethereum Alliance. Can only gesture with one hand. That's like silencing me. But I want to talk about the future of money, and in particular, I have this idea that the future of money is fundamentally about streaming, right? That we are literally going to go from this traditional model of sending money in quarterly or monthly chunks, and we're going to move over to a streaming model where we move money as we need it, when we need it, in relatively small increments. In fact, at increments that are so small that people today might be surprised at how small they're going to get. So let's talk about what's driving this. First and foremost, what's driving this is global regulatory convergence, right? If we wanted to have banks and other businesses work on chain, use stable coins, really have to have regulatory compliance. And that's what's happening all around the world. It's a very positive thing. Individuals in small countries are dollarizing. They are dollarizing. They're transacting on chain already. But if you want to have your electric bill, your utility bill, your taxes, your business transactions and payments done on chain, it has to be regulatory compliant. So governments don't go after individuals. They don't go after the person on the street corner, but they absolutely go after large companies with deep pockets. So regulatory, kind of global regulatory convergence is extremely important. And indeed, now that this is happening, there is an absolute stampede going on into the stablecoin space primarily. I think I've seen our business kind of explode. Everybody wants to have a stablecoin strategy. Companies want to know, should they have their own stablecoins? All kinds of things like that. So this business is absolutely booming, and you can also see it in the actual stablecoin volumes. What's driving demand? 3 things I believe driving demand. Number 1, people are buying assets with stable coins. So, even though there's a lot of talk about ETH as a store of value, the truth is most of the store of value that's on chain today that's actively being used in investment is stable coins. It's being used to buy assets, real world assets, digital assets. Secondly, consumer payments. Consumers are paying each other. They're paying for stuff. Again, especially in emerging markets that are dollarizing. And then lastly, we're at the beginning of a whole business ecosystem development process where large companies are going to start transacting with each other and with their suppliers and business partners around the world. Over on the consumer side, what does this mean? So for consumers, we are getting very quickly to a point where banking on chain looks and feels pretty much indistinguishable from banking in the real world. Now, I want to say that banking on chain is still messy because of the horrible crypto UX, right? We love to complain in crypto about the user experience, but I took my actual 17-year-old son to a real bank branch to try to open a bank account for him, and it took us 2 hours of paperwork. So complaints about the crypto UX feel kind of quaint after you spend 2 hours showing your passport and birth certificate in an actual bank branch. But it's getting better on chain. We have a very similar process taking place for businesses where banking integration and crypto integration are starting to look the same. So first and foremost, unlike consumers, businesses care about regulation. Secondly, unlike consumers, which seem to overwhelmingly want US dollars, businesses actually want local currencies, right? If you're an enterprise and you're transacting in Argentina in pesos and you're regulatorily required to do so, you want to transact in the global transactions on chain, you're going to need local currency. And I believe it's B2B transactions that are actually going to drive demand for local currencies on chain. They want stablecoin interop, right? There's literally hundreds of US dollar stablecoins. They need confidence that they're all going to be interoperable. They're going to be easily exchangeable. Banking integration, very important. And ERP integration, right? How many of you have heard of SAP? There's a few of you. SAP is the main software system that large companies run on. Everything runs on large companies inside of SAP. And this is really important because if you want a company to do something, it's going to get done in SAP, right? And so last year, for example, EY became the first company to receive a fully automated stablecoin payment to our institutional crypto provider through SAP. SAP has built a wallet for their enterprise system, and they built institutional integration. And so as a result, we had a client, they paid an invoice in PayPal's PY US dollar stablecoin. It showed up in our computer system as cash paid against that invoice. So really, really important. Basically, once you have this SAP integration, making a stablecoin payment is for large companies, it's exactly the same. Making and sending looks exactly the same as doing a bank integration payment. And that's really important because large companies really don't like doing things that aren't kind of fully automated and plugged into their systems. So where is all of this going? I talked to the title of this presentation is The Future of Money is Streaming. And this is what I'm talking about here. Right now, today, we stream music, but it wasn't like that. And some of you are much too young to remember, but once upon a time, in a galaxy far, far away, we bought analog albums, right? Which you can still buy in like special shops that are hilarious. My son actually buys like analog albums. He's like, Dad, do we have a record player? I'm like, that was thrown out a long time ago. And then we bought whole CDs. And at a certain point, it got cheap enough and easy enough that we started buying and downloading or stealing and downloading individual tracks, right? And eventually we just gave up and we went to streaming. We don't even stream a whole song anymore. We stream like tiny bits of a song. And the argument I want to make is that this is what is going to happen to money, right? Once upon a time, we got paid every 2 weeks and we got bills monthly and we paid our mortgages or our rent monthly. I believe we're slowly going to go away from that. And what's driving that is this transition that blockchain is making affordable and possible. We are in the middle of a payments transition from things that cost dollars and took days towards things that basically cost under a penny and take less than a second. And once making payments is essentially free, the idea that you would change how you run your business, especially at a global level, starts to become really appealing. This idea of like, why would I wait a whole month or why would I keep big piles of money everywhere just in case becomes unnecessary. And I think what we're headed towards, for example, at the enterprise level is a completely different way of managing your treasury. So today we have global treasuries, but they don't keep a lot of money. Where you keep the money is in the individual operating countries. But if payments are free and instantaneous, you're going to have a big global treasury that's centralized and aggressively managed for yield. And then you're going to have little small bank accounts in other countries that just keep the minimum amount of money necessary, right? So if you pay your workers on Friday, then a Thursday night at 11:59 p.m., you're going to send the money for that, anything that's needed, right? But basically, the whole process is going to shift from big chunks of money to tiny amounts streaming over time. And the result of that is going to be kind of a just-in-time payments and financial system. And it's not just how companies are going to manage their treasuries. I believe it's also going to affect how basically enterprises and consumers interact with each other. And I'll give you just two very specific examples. It's pretty common in the US and Europe that companies have incentives not to use energy during peak time periods. The problem with these incentives is they're not very powerful. Like if you want to run your dishwasher tonight, right? Okay, yes, it's going to cost you 25 cents more in electricity, but the problem is like your electric bill is not coming for 30 days. On the other hand, if you're paying your electric bill every night for the electricity you consume today, a savings incentive that's valid today and pays out today, it's much more effective. And the same thing turns out to be true with working. You work on an hourly basis, you're a gig worker, you drive an Uber, you deliver packages, right? The incentive to do another package, do another delivery, take another ride, it's much more effective if you're getting paid today for work you did today. And in fact, we have data from social research scientists that basically says incentives like these are 100 to 300% more effective when the payout is the same day than when it is 30 or 60 days away, right? And by the way, if you're an enterprise and you have you're the electric bill or the gas company or the phone company, today you extending your customers 30 days of credit every month. Why? Why not charge them every night? You have the data systems. It's not like the old days where people didn't know how much they consumed. They know now, so you can charge them literally every single night for any kind of incremental product or service that they use, and you can pay them. You can do daily payroll. So my prediction is that although this sounds crazy, we are headed into a world of basically streaming these transactions pretty much in near real time. What's been missing is all of the integration and the infrastructure required to do this. And now that we have both the regulatory compliance and the technology available to do it, we're starting to sort of accelerate towards that path. And that is kind of my expectation, right? We are at the beginning of this acceleration phase. And if you go back to the story about music, so it took quite a while into the digital age for music to flip from a purchase to a subscription and from a download to a streaming model. And I think we're in the same phase here now in the world of crypto and blockchain. We are several years into the crypto era, but it's taking time and maturity for people to see the power of this business model and think about how to move forward on it. So I think we're at the beginning of a very substantial transition in payments over time. I will just finish up with a little bit about, so I'm from Ernst & Young. What is it that we do? We do three things. We do the traditional thing. We do four things. We do traditional things that you would expect a Big Four accounting firm to do: financial statement audits, tax accounting, business consulting. But in addition to that, we are an ETH maxi firm and we invest heavily in blockchain engineering. If you haven't heard of it, we have I'm going to talk about this tomorrow. We have a layer 2 privacy technology called Nightfall. It's deployed on Plume. It's deployed on Cello. We also build smart contract security auditing. I'm the chairman of the EA in the free time. And I even managed to get Vitalik to endorse my book, which is apparently safe and effective for falling asleep without any drug use, if you have jet lag. And then lastly, thanks for listening. And if you would like it, I have a limited edition NFT minted on the Base network that you can have it's called a proof of Paul. And I also have, if you want to see me in person, I have POAPs as well, limited edition POAPs. And that is it for my talk. Thank you very much.
Abstract threat. AI is no longer an abstract threat. It's causing job loss right now, and the headlines, they tell the story. The Massachusetts Institute of Technology, MIT, on Wednesday released a study that found that artificial intelligence can already replace 11.7% of the U.S. labor market, or as much as 1.2 trillion in wages across finance, healthcare, and professional services. The New York Times recently reported that Amazon is on the cusp of replacing what would be 600,000 warehouse jobs with robots and plans to automate 75% of its operations. CNBC reporting that Salesforce, Walmart, Paramount, UPS, YouTube, and Meta have all announced new rounds of layoffs attributable to AI, with nearly 1 million job cuts nationwide this year. That's the job loss that we can measure. Now consider what some are predicting about the future. Goldman Sachs estimating that 6 to 7% of the U.S. workforce could be displaced due to AI adoption. They do note, however, that the impact may only be transitory because new opportunities created by AI might ultimately put people to work in other capacities. A report by the McKinsey Global Institute finding that AI could displace 40% of American jobs due to automation by 2030. That analysis found that robots and AI agents could automate more than half of U.S. work hours, both manual and cognitive, using technology that's available today if companies redesign how they'll do things in the future. The World Economic Forum projecting that 92 million jobs worldwide may be displaced by 2030. Ford's CEO saying that AI could replace half of all white-collar workers there. NYU professor Scott Galloway predicting that AI will hit middle management first, noting that 6% dropped in managers at public companies since 2022. So here we are, AI eliminating jobs, more automation coming. If millions of people lose work, how will they support themselves? This is where an idea from the 2020 presidential campaign returns to the conversation. Universal Basic Income, or UBI. The concept, pretty straightforward. Every American adult would receive a set check each month. For Cook County, Illinois, which includes Chicago, this concept just became reality. The Cook County Board of Commissioners unanimously approved its 2026 budget proposal just this month. It includes $7.5 million for a guaranteed basic income program. Commissioners approved it after the success of a pilot program where the county provided $500 a month to 3,200 households over 2 years. Survey findings based on that pilot revealed that 94% of the program recipients used the funds to address financial emergencies. 75% reported feeling more financially secure. 70% said that the program had a positive impact on mental health. Of course, there's the question of how do you pay for it? In the case of Cook County, as a result of the decrease in commercial real estate values, everybody's property taxes are now sky high. In Chicago, rising 16.7%, the largest jump in at least 30 years. West Garfield Park saw an increase of 133%, North Lawndale 99%, Englewood 82.5%.
You think you know David's story.
Episode of Bits and Bips, where we explore how crypto and macro collide one basis point at a time. I am still your host, Austin Campbell, High Scholar of Zero Knowledge Group. I'm here today with friends Chris Perkins, the Golden Hand of Coin Fund, Ram Alawalia, Maester of Wealth, leader of Lumina, and coming to us from an undisclosed and secret location, one of the original hosts of Bits and Bips, Alex Kruger of Kruger Macro, protector of the realm and apparently enemy of the regime. We'll find out more, depending on what he wants to disclose. But we're here today to discuss the latest stories in the worlds of crypto and macro. Please remember that nothing we say here is investment advice. Check unchainedcrypto.com, Bits and Bips, for more disclosures. Now, before we begin, we're going to start with a quick word from the sponsors who make this show possible.
Mantle is
meeting, pushing yen higher and bond yields higher, or the Bank of Japan rate hike.
level. More liquidity, less complexity. Visit hub.uniswap.org to learn more.
All right. So we're going to start with the topic that has led to some indigestion in the crypto market right now, which is the Bank of Japan rate hike. So the BOJ signaled a likely rate hike at the December 18th to 19th meeting, pushing yen higher and bond yields higher. USD JPY is moving significantly. And markets are currently pricing well over an 80% chance of a hike to 0.75%. It's the clearest signal yet of tightening from the BOJ, framed as easing off the accelerator rather than applying the brakes as real rates remain negative. But the genesis of this is that one of the most common funding trades in foreign exchange markets is the yen carry trade, where you're borrowing in yen, converting to another currency, and usually lending out at a higher interest rate. Thoughts are that maybe this will unwind. I'll be curious what people have to say about that. But overall, the market had a sharp pullback on this. Bitcoin fell below 84K briefly. ETH and Sol were down 10%. The biggest loser, of course, Zcash, because the Bank of Japan strongly opposes privacy. Maybe correlation is not always causation, but let's start with Chris here. Chris, what do you make of this as somebody who's been in Forex markets yourself?
Well, look, I think we talked about it last week, and the unwind of the carry trade has been looming in the background. It's obviously, if you have a scoreboard, I think it's a negative on the sheet. We're going to talk about some of the positive things that we're seeing as well. But it's a little bit different last correction that we saw, where markets were shocked in August of 24. And that really hit prices. But I think our thesis is generally that if you look at recent weakness in Bitcoin, particularly around November 20th, 21st, the world's changed a little bit since then. And yeah, maybe you still have some of that carry trade unwind weakness in the background. But look, if you look at like a poly market right now, there's just about 100% chance now that rates are going to, the Fed's going to decrease rates by 25 basis points. Back to last time Bitcoin puked out, we can maybe even try to share a screen here. It wasn't quite like that. You had, let me see if I can do it wrong. Last time Bitcoin puked around the 21st, so it's only a 34% chance that the Fed was going to decrease. Now that's probably been priced in the markets already, but that's positive. All right, I'll stop there, but it is what it is. We still feel long-term bullish. We're going to talk about all the good things happening across the board. I mean, even Vanguard just came out as we were launching. They're going to start offering crypto ETFs. So it's all slowly happening. I think this is part of my greater thesis around retail is ebbing and flowing. They're still recovering from 1010. They're still, market makers are still recovering, and institutions are still marching forward. Evidence is Vanguard coming into the space.
Ram, what would you add?
I guess high level, I'd say, look, I think high beta assets are just under pressure. They've been lagging. Value stocks are being growth. If you look at the S&P value index, all-time highs last Friday. The S&P is right behind it. The growth index was 8 points lagging that. So it's a bigger issue than digital assets. It's true for uranium. It's true for the Palantirs and the Robinhoods of the world. This high beta sprint that we've had since April is just giving way to a rotation to value. The USD JPY, I think, is still not a primary driver. And if I share my screen here, you can see that it looks like a one and done. We've had pullbacks in the USD JPY of similar magnitude, including as recently as October 10th. Like the attractiveness of that carry becomes less as US dollar funding rates go down and Japanese funding costs go higher. That's true on the margin, but it's a slow moving thing and people see it coming. So it's hard for people to get offsides on it. I think it's really simply that animal spirits are just fatigued and they're pulling back after what's been an incredibly strong kind of performance in assets away from digital assets, namely these, other categories of animal spirits.
Alex, what do you think?
I think people has this need to always have an answer to why something happened. Is very powerful, and oftentimes, after it happened, it doesn't really matter. It's already happened. But that being said, there's been a lot of discussion of what triggered this last move. Things were looking good. I felt extremely confident that the test of 8,500 on the 21st was the bottom. I'm not as sure anymore, given the violence of today's move. But I was feeling very confident based on pretty much almost every single metric out there, from IB to skew to RSI to fear and greed to you name it. Everything screamed bottom. Now, this is not a market that is trading like the bottom is in, so I don't know anymore. The way I see it is, it's very asymmetric at the time. What's the way Bitcoin is behaving versus other risk assets? Granted, things like all quantum stocks got crashed last night as well and today. But that being said, the news and what happened on Japan didn't really warrant a drop from 91 to a 6% drop in no time. Some people argue that it wasn't really Japan, but if you zoom in and if you put a chart on, you're gonna see that basically the move starts at the exact same time in synchrony with basically the JGBs, the Japanese bonds, and the Nikkei, and everything moves at the exact same time, and it opens. It's basically at 9 a.m. Japan, which is 7 p.m. Eastern time. That's the move that's the trigger. That doesn't explain why Bitcoin moves so much more and then basically crypto collapse. That's I think is what Chris alluded before is an unfortunate corollary or aftermath of 1010 and yeah, I think that's it. Right now things are looking a little bit better. It's been very interesting. The MicroStrategy it's pulled back almost entirely today's move. So again, the way I see it is first was Japan overnight, and second at the open, MicroStrategy brought the entire crypto complex down. So now things are bouncing, and yeah, that's it.
I think a common thread between a lot of the things that are moving around, if you're looking at Bitcoin, if you're looking at alts in the crypto space, if you're looking at quantum stocks, if you're looking at MicroStrategy, is it's all, one, the momentum stuff writ large, as Ram was alluding to earlier, because value seems to be doing comparatively better. But two, it's a lot of the things that people seem to like to, we're going to call it over-lever themselves on. So I wonder how much of this is a core, call it economic flush, like something based on fundamentals where if people had been unlevered, we'd still have seen this level of violence, and how much of this is people, especially in crypto, just not being able to help themselves with the leverage that produces, market moves like this. Sunday night, relatively notorious time for large crypto moves on thin liquidity because of leverage. And so when I'm looking at, call it this level of market reaction to what should have been a pretty expected headline in some ways, sometimes the trigger that I'm looking for is leverage pain points there, which, has interplay throughout all these other things. I mean, Ram, you were earlier talking about the animal spirits component of that. What do you think is going on with, like, call it leverage dynamics in retail in this context?
I think retail investors own a lot of the same positions that are cross-correlated, even though they appear distinct on the surface, whether it's digital assets or uranium or quantum stock or like SoFi stock. It's all the same trade. It's all just like high beta. And so when one sells off, they've got to sell the others. And so high beta is just selling off in unison. And the other thing you see out there is, like, there are quality stocks for the first time in a very, very long time that are attractively priced. Quality's been a bubble. Costco had a 50 times PE ratio. Now it's 45 times. It's still a bubble. But the other things out there that are not, like S&P Global or maybe ICE. So if you're an investor and you're looking around and you say, gee, where do I park capital? I think people park in quality assets. That's what you're supposed to buy when they're cheap. So I don't know that you'll get the same reflexive response from animal spirits this time around. Previously, those other assets were just priced high. Now they're priced low. So why wouldn't people go in that direction? Especially if there are concerns around the strength of the economy, whether that's legitimate or not. People have those concerns. Why wouldn't they just park in that direction?
Thesis there being ultimately a rotation to, for lack of a better way to phrase it, defensive stocks on a forward basis.
Quality, value, defensive stocks. And I think even small cap value, which would benefit from rate cuts, because a lot of these names have a lot of leverage. And if they can refinance their debt, they would benefit. So, value stocks in general will have more debt than growth stocks. So they'll benefit from lower rate cuts. I think it's another reason why that's been outperforming. I expect that would continue to happen in the future. Like, we are positioning in that direction.
All right. So then I want to ask the follow-on question as we sort of take that thesis and move it to other markets. Do you think following that corollary means that we should be expecting better performance out of Bitcoin than alts if we're going to see similar behavior in crypto, or do you think it all just trades correlated?
Bitcoin should outperform alts, I would expect. I think that's probably an easy view for probably all of us to have here. I don't know if anyone would disagree with that. That's probably an easy view to take. It's an easy view to take.
I always worry when something's an easy view that we're wrong, but yeah, fair enough.
Yeah.
All right. So let's talk a little bit about one of the drivers for Bitcoin then, which is strategy. Oh, go ahead, Chris.
Yeah, no, I was going to jump on strategy. It's the CEO, Michael Saylor is the executive. People think he's the CEO. He's actually not the CEO. The CEO piped up and said, yeah, if we went to a negative MNAV less than 1, well, yeah, I could see a situation where we could sell some Bitcoin. And I'm paraphrasing. The market didn't respond very nicely to that. And like the other thing about Bitcoin that's a little bit curious right now is it's really decoupling from gold. It's acting like that risk asset again, digital gold. I think many of us think in time that's going to fix itself, but it's still being perceived as a risk asset. But like honestly, it's a little bit concerning when something which I think is kind of obvious. We talk about DATs all the time in the show. DATs need to have thoughtful treasuries. They need to be prepared for times when MNAV is less than 1. They should have adequate reserves to be able to manage those situations, ideally not dumping their underlying assets. But the market seemed to be acting a little bit asymmetrically to that one comment on a podcast or whatever, which is unfortunate. But again, I think that's like retail being retail. And I do still think that there's, like I said, like Vanguard is now saying they're going to buy ETFs for the first time. It's a pretty big deal. I think they're 11 trillion under management. So again, I think time fixes a lot of this stuff.
Yeah, I mean, so to fill out the strategy thing, their current MNAV is slightly positive. Continued price declines will push that lower. They announced they have a 1.44 billion reserve to cover 12-ish months of dividends and debt interest. And the CEO, Feng Lei, said, math says sell, emotion says don't, but math usually wins. Chris, I would say, responding to you, and especially knowing the amount of retail interest in strategy, I think one of the problems with his comments was not on the fundamentals. I agree with you. DATs should be thinking about treasury management, and they should be very careful with debt, and pre-funding is not a bad idea from a long-term stability standpoint. I think the problem was a narrative violation, right? Which is to say people viewed Saylor as like the diamond hands, the one guy who would never sell. And now here's the CEO of strategy being like, no, we would totally sell if we had to. Like there are corner cases where if we're putting that, or at least in their eyes, corner cases where if they're put in that situation, they will be selling Bitcoin to fund dividends or debt. Yep. And again, I'll remind everybody, that stuff's not optional. If you don't pay your debt, you go into default, and then your company is going to end up being restructured or forcibly unwound. So from a corporate responsibility standpoint, this is kind of the thing they have to do, right? It's fundamentally not really optional. It's the same problem many DATs are going to face trading at an MNAV discount. But I feel like strategy was perceived as the one that would never do that.
Yeah, they have an operating business that's better. Go ahead, Alex, go ahead.
Yeah, the CEO did mention that the level that would require them at the time right now to sell Bitcoin for dividends would be 25K, and that's been absolutely not reported absolutely anywhere. But he did say that. So they're big against the own goal that he did because of course it's not going to be reported. You said what you didn't have to say.
No, there's always what is the
I would like to welcome everyone to FinWeek Bratislava 2025, the 9th FinWeek so far. It's my honor to be the moderator for these panels. We bring together fintech leaders, regulators, innovators, and policymakers from Central Europe, ASEAN countries, and beyond. Before we begin, I would like to thank our partners who makes this event possible. Decta, Gold Value, all our support. I would like to welcome our panelists. We have Gregor Boltar from Slovenia online. Welcome, Gregor.
Welcome, everybody.
Martin Peter, Head of Banking Department, Ministry of Finance. Jan Prochadzka, Member of Bank Board of Chernobyl. Great to have you here. Jonathan Middleton, all the way from the UK, Director of Financial Services. Peter Penses, Head of Crypto Asset and Innovation Section at National Bank of Slovakia. With no further ado, we will start the panel discussion. And the opening question is a broad question. MiCA in practice. Let's get practical on MiCA. What are the most common and costly mistakes firms are making right now when applying for licenses? Are national regulators truly equipped to handle the load? So we start with the negative part and hopefully finish on a positive note in the end of the panel discussion. This question is mainly for Peter Penses and Jan Prochadzka. And Peter, you can follow up after them.
Yeah, thank you. MiCA is very topical issue now. Thank you for the question. We are now in the process of handling applications we received, and you asked about the common mistakes. And the common mistakes are mostly related to money, people, and IT security, those three areas. With respect to people, MiCA requires directors of crypto asset service providers to be able to oversee the whole operation of the company. And since the companies are usually small, they have difficulties to prove that the single director, because many applicants have just a single director, is able to oversee the operation of the whole company. The other common mistake is they misread the prudential requirements. It's not only fixed amount of capital they need to have, that amount of capital depends also on total costs they incurred in previous periods. And they often think that having 125,000 euros is all that they need to prove. And the last one is the IT security. For crypto, IT security is not negotiable. So we require them to prove with penetration tests that their IT security systems are robust enough. And that is costly and that takes some time. So those are the most common mistakes we see on the part of applicants. And then you asked about capacity. Yes. I think here we should take a more global view on what's going on in Europe with MiCA. Currently, there are about 90 MiCA entities on the market. Out of those 90 companies that get the MiCA license so far, 40% are traditional financial institutions that extended their services to crypto world. They do not need to undergo the whole licensing procedure. They just notify competent authority that they want to enter crypto market. They submit very limited amount of information, and then after 60 days, they may start operating. We have N26, Revolut, Clearstream, TradingView, banks and investment companies that did just this. They just simply extended their operation into crypto world. And the rest, the 60% of the entities that have MiCA license, if we look where do they come from, they are French, German, Dutch, Maltese entities established mostly in these 4 countries. And why is that? Because these countries had quite robust pre-MiCA regimes. So the learning curve these companies had to take before applying was much shorter than the learning curve in Slovakia, in Czech Republic, or in other countries where there was no such a steep learning curve to get the license. And coming back to the question about capacity, I think we have capacity to do our job right. It's not our job to do licensing fast. It's our job to do licensing properly and to build really sustainable crypto market.
Thank you. Jan, will you follow up, please?
Yes, of course. Thank you very much. So you said, let's go practical. So I think Dua Lipa is singing, let's go physical, but it's a good idea. So I'll just continue. I can just sign what Peter mentioned. In Czech Republic, I will speak about Czech Republic because I think that we are some kind of real life testing ground for MiCA, because we have 233 applications for MiCA in Czech Republic. So it's quite surprising. It's maybe quite shocking, but it's a real fact. And what was mentioned here also, we have so many countries, not 4 of them. We have like Kenya, Uzbekistan, South Africa, so many countries all around the world. So there is nothing like some Baltic stream or something. There is all around the world. And we have to also question ourselves, what is the reason why they are asking us, mainly if this is I don't know, strength of the regulator, or I don't know, the openness of the regulator, or our discussion about Bitcoins in the reserves, maybe. But we were thinking about it, and maybe one point is that this is a fee structure, because our fees, license fees are quite cheap. We have less than 1,000 for the fee, so it's 800 euros, I think. We have no monthly or yearly fee in the supervision fee, so maybe this could be the reason. Other reason is that we have 30,000 VASPs, so these providers of the crypto services. We have 30,000 registered in Czech Republic, so there's also
the first panel. We might have a small crowd, but I assure you this is probably going to be the best discussion for today. So the panel is the institutional bridge to DeFi, how funds engage with yield, governance, and risk on chain. I'm going to start off with a quick round of introductions, and then we can get right into our conversation. So I'm just going to go down the line here. Charlie?
Great. First of all, thanks for moderating, and thank you to the TIE for hosting us. My name is Charlie Cooper. I'm the Chief Operating Officer of Ava Labs. Ava Labs is the software company that stands behind the Avalanche ecosystem. I've been with Ava actually now a little bit over a year and in the COO chair for a little under a year. Our ecosystem is best known for its L1 construct, its L1 blockchain construct, which allows customizable L1s to be built and plugged into us. And we cater to both the retail markets and sort of the most innovative crypto native, crypto maximalist communities, as well as to institutional, with a whole host of different technology and product suites, as well as a business team that helps those guys get running and off the ground. So that's me.
Thank you, Charlie. My name is Roger Zhang. I'm the head of US of InChain Groups. So basically, we're an Ethereum debt company. We're one of the first company who put Ethereum on our balance sheet since 2024, and we are second largest Ethereum debt company on 2024. And also, besides that, we're an altcoin mining company. We produce lots of killer products like Dogecoin miner, Leo miners, and we will continue to use our profits to selling those miners to reserve more Ethereum and support the Ethereum ecosystem. Thank you, guys.
Hey everyone, Rob Haddock. I'm a general partner at a fund called Dragonfly. We're about $5 billion under management. Been investing in and around the space since 2018. Great to meet everyone.
Hey everyone, Pascal Saint-Jean, President and CEO of 3IQ. We're a global leader in digital asset management. We see ourselves as the bridge, no pun intended, to helping bring more institutional capital into the space. We started with an ETF framework, first globally many years ago, but today our focus is on our managed account platform, really trying to bring sovereign, pension, and multifamily office capital into the space. And DeFi is our sort of our next venture to get into, to bring DeFi capabilities into this, to bring more institutional capital to support the emerging managers that are coming into the space looking to deploy on DeFi.
Great. And just to round it up really quickly, name is Thomas Chen, CEO of Function. We are a Bitcoin yield marketplace, 1.5 billion TVL, backed by the likes of Galaxy, Bybit, and Mantle. The first thing I want to call out is just how diverse this crowd is, right? So you got representatives from a major L1 chain, a DAT company, a major VC, and a major asset manager. So the perspectives here can really shape how the different participants in, call it TradFi, look at the DeFi ecosystem. So the first question I want to ask, and the first one's going to be directed to Pascal first, is when institutions think about getting into DeFi, what does that mean? Is it chasing yield? Is it portfolio diversification? Is it trying to control the infrastructure? What is the main motivation behind getting into DeFi?
Sure. So again, the word institution is large and wide, so everyone will have a different opinion. So when we talk about institutions, it's primarily large allocators. So think about your multifamily offices, not necessarily just servicing crypto, but servicing large wealth, banks, sovereigns, and pensions. So their interest right now, it's still early stage, but is fundamentally, of course, chasing the next generation of alpha, and of course looking for more liquidity. Right now, if you attend large institutional conferences, you'll see the main pain point is liquidity, and the crowded trade in private credit, the crowded trade in private equity, and the lack of liquidity in those funds. They're starting to say what's next. And so DeFi is sort of showcasing that potential promise of either unlocking liquidity on these products if they get tokenized and DeFi has enough liquidity, and or looking for the next generation of yield outside of private credit and private equity.
And as a fast follow-up to that question, where do you draw the boundary on what you define as DeFi? Is it just the majors or some of the alts? Like, where does the line stop from a regulated institution?
They don't know. They just used, right now their understanding is basically, decentralized finance, and they don't understand exactly what's going on. They'll associate tokenization to that. Necessarily tokenization can be on DeFi. It could also just be on chain. So they don't fully grasp that. So we're doing a lot of that education for them to understand that you could tokenize and basically go through centralized parties, or you could tokenize and deploy on DeFi and then start accessing more liquidity. So we're doing a lot of work with them. I still say they're a few years away, which we'll talk about in some of the future questions.
I'm going to hop around here. Charlie, I'd love to hear as your view as the opposite side of the equation, right? So we've got asset managers on one side and then the major L1s on the other side. Are you seeing that type of conversation, that type of flow coming from institutions? What does that look like when institutions are getting to DeFi?
Future questions.
I'm going to
Of course, beyond chain. So they don't fully grasp back. So we're doing a lot of that education for them to understand that you could tokenize and basically go through centralized parties, or you could tokenize and deploy on DeFi and then start accessing more liquidity. So we're doing a lot of work with them. I still say they're a few years away, which we'll talk about in some of the future questions.
I'm going to hop around here. Charlie, I'd love to hear as your view as the opposite side of the equation, right? So we've got asset managers on one side and then the major L1s on the other side. Are you seeing that type of conversation, that type of flow coming from institutions? What does that look like when institutions are getting to DeFi?
It's significantly more complicated and slow than people want to admit. And I think the part of the reason for that is if you, at their fundamental definitions, TradFi and DeFi are about as far apart as you can imagine in terms of how they're structured and what they're trying to accomplish. And if you look back at the, the original foundational elements, Bitcoin white paper and the rest, crypto is effectively invented to put the institutions out of business. And over the course of time, there's been a recognition on both sides of that equation that we actually need each other in order to thrive and to get the most out of both of what we have to offer. That's a scene setter. What that means then as the institutions that we're talking to, and we have many institutions that are clients of ours that are already live on us, but not doing nearly as much as we would like to, right? We always want to encourage more and more and more, and we get excited by the little things, is that some of the core problems that institutions still face and some of the core capabilities, risk management, infrastructure pieces, et cetera, that they need to fully adopt DeFi are not yet in place. And that means it's up to companies like us to build that for them. And it's up to the DeFi companies that are trying to get the institutions interested in them to speak to the institutions on their terms. So as opposed to a DeFi protocol coming in and explaining why their business model is so much better and that the institutional play is old and beaten up and all the rest of it, it's learning to talk to them and giving the institutions assurances that while they're doing something incredibly innovative and different and ultimately beneficial for everybody, they understand the pain points along risk management and compliance and infrastructure and operational risk and all these various different things. If a DeFi platform or protocol attempts to make a sale to the institutions by saying, we don't need any of the stuff that you used to do, we're going to completely revolutionize it, you've immediately alienated the client and you've shown that you don't understand their business model. And so I think it's really important when you're asking the question about how these come together, it's really important for both sides to recognize the benefits they bring to each other, but be willing to talk to each other on the other's terms to try to understand how they can work better together. And I think sometimes we talk past each other.
I think that's a recurring theme within DeFi for sure. There's a lot of different things you touched on there, Charlie. I want to move on to Roger, and from the perspective of as an ETH DAT, right? It almost feels like traditional institutions are getting comfortable with DeFi, but through a wrapper, which is effectively a DAT, ironically. From your perspective in running the DAT, what have you seen? Is the institutional appetite right now just primarily converging around DATs as the main vehicle or main mechanism to get exposure, or do you see them asking for more?
Yeah, that's a really good question. So basically, I think when you choose a DAT company, it's not only like right now people are choosing based on the market cap, right? Based on the trading volume. But I think in the end, like forward seeing, like we want to choose a DAT company that eventually gives you more Ethereum per share, right? You want to choose a company that gives you like 2 Ethereum after like 5 years instead of give you like just 1.1 Ethereum after 5 years. I think those kind of company ultimately prevail, and DeFi helps a lot of that. So if like a lot of like DAT company recently, they're just doing simply staking that gives you like 3 to 4% annualized yield every single year. But like there are lots of like almost zero risk tricks that you can boost that. For example, we are running a solo validator, right? That gave us a MEV yield of like 1 to 1.5 every year. And also when we purchase the Ethereum, we are selling the puts with the Falcon X. So basically largest OTC desk of like Ethereum purchasing. So every single Ethereum we're purchasing, minus and premium, we are like 2% cheaper than anybody else. And plus those MEV yield, the native yield we are getting for pure Ethereum is around like 6 to 7% every single year. It's almost twice than you only do simple staking, right? And not to mention, this is only the beta. There's a lot of alpha on the DeFi as well. And I don't know if you guys know that, but back in 2023 to 2024, there's a platform called EigenLayer. One of the largest like Ethereum holders I know get 25% more Ethereum just by single years by staking on the EigenLayer. They get lots of Eigen airdrop. They get lots of like AVS token airdrop as well. And lots of those AVS projects eventually get listed on Binance and Coinbase. And they have a huge profit selling all those tokens and purchasing back even more Ethereum. And that basically, if you trust EigenLayer's like security, like it's almost like a zero risk like strategy. You can get like 25% of like Ethereum just by 1 year. And not to mention just 2 years before that, we have DeFi Summer, right? So I think every 2 or 3 years, there's a huge opportunity for like an Ethereum holder to get like 20 to 30% Ethereum by a single year. And forward looking, like every 5 years, like after 5 years, I definitely think some company will twice the Ethereum amount. There's a company that is large and lazy and doing nothing by just holding the Ethereum, right? So I think DeFi gonna help a lot, and DeFi gonna ultimately provide this kind of offer opportunity in this industry, and people who chase him will get rewarded. Yeah.
So there's no doubt that there's an incentives-driven market within DeFi and TradFi. You touched on the MNAV, right, for a DAT company and what's important is there on a price per share basis. I'd love to turn over to Rob. From your macro viewpoint and also being in the trenches, how are the incentives changing, right? The dynamic between TradFi and as well as DeFi. Do you see TradFi starting to dip their toes more into more DeFi native trades?
I think it kind of depends on what we're talking about, right? So a lot of the conversation to date around institutions being involved on chain has really been about like asset issuers saying like, is there somebody new who will buy my asset, right? Like, am I Apollo and I can do this thing with ACRED, which is their private credit fund? And is there somebody where there's already capital on chain, a foundation, somebody like that who will buy this, right? I mean, Janice Henderson did this CLO product. It's got $1 billion outstanding. The buyer is just Sky. And Sky is, essentially just backing their, their stable coin, right? With it. That's a sort of an uninteresting thing to me, right? As a venture capitalist, because it's just, an asset issuer figuring out if there's some new market that it can tap. We've started to see a little bit of changes or a little bit of experimentation around, okay, well, now I have this asset, but can I do some sort of like novel net new trade that I couldn't do otherwise, right? So like with Apollo ACRED, theoretically, not theoretically, you can actually, through Securitize, go and lever it up, sort of like you can loop it, as we call, on Morpho 5 times. It gives you like, it's essentially net 3x leverage. It goes from an 8% yielding asset to a 19% yielded asset with like, Apollo underlying private credit fund. Like that's a net new thing. And the minimum in that is 10K. That's a net new thing that you couldn't have done like through JP Morgan. It would have taken 7 weeks and you would have had 15 committees who would have told you like, there's no reason we should lever up this private credit fund, right? And so I think what we're starting to see is people say, okay, well, is there things that I can do programmatically that I can do on call it a shared ledger that, coordinates trust across different counterparties and can get like, yield in like real time versus like having to worry about like, weekly settlement with the bank or something like that. And is that a product that I can then offer to the end customer? We're really, really early in that, right? And I'd be shocked if we had that type of like net new novel product being offered anytime to, in real size to real customers in the next couple of years. But there's a lot of work happening around it. And there is a lot of infrastructure being built around it. The DTCC actively looking about how they can do tokenized settlement for tokenized assets, especially around private credit or private equity. Right now, you have a lot of people thinking through at the large trading firms, like, what do I need in my back office software systems to be able to do repo and things like that with the banks. And so as you get these types of customers starting to build with certain types of tokenized assets, and by the way, stablecoins are just a tokenized asset, it becomes more of a snowball, right? And so it's like slow and slow and slow, and then it's a lot bigger than you realize. But I think we're still very far away from there being, call it, there might be tokenized assets, but that's very different than people actually participating in DeFi.
Absolutely. This is not even a hot take, but I think a lot of the game right now is just printing TVL and putting it on RWA.xyz. But that's just the incentives that we have today.
Well,
right?
well, let me look at, like, if you go on RWA.xyz, like, and you look at the assets there, most of it is Figure, right? And Figure, great business, $9 billion public company, HELOC business. There's not really anything that exists on chain, to be honest, right? So like they're posting some data like every once in a while and saying, hey, we have all these HELOCs, and yeah, they're getting rid of some of the servicing and origination fees. And it's like they've done, Mike's a fantastic entrepreneur and he's done a great job with that business, but nobody's looking at that and being like, oh yeah, there's like DeFi happening here, or there's like real like activity happening on chain here.
So I want to extend that question to Pascal next. So from your perspective, what does that unlock that needs to happen for you to start allocating? Let's get specific, right? If you're in the investment committee and someone comes to you and says, hey, we actually want to start making this up, looping, probably not. But if they did, what are the actual items in a checklist if that's the way that you evaluate?
Yeah. So I'll take things a little backwards so you could understand how far we are, but it's going to get to where we all believe it's going. I believe that's where people are starting to. That's where the puck is going. Sorry, I'm Canadian, but fundamentally, if we talk to a lot of these large players, and what the ETFs did, for example, what IBIT did is it created an investment-only decision and not a compliance decision as well. For example, Mubadala, we have a presence in the Middle East. We talked to all the sovereigns. Mubadala was interested in Bitcoin for quite some time as an asset to add to their portfolio. Then there's a discussion of like, how are we going to custody? Who are the counterparties? How is this going to work? Et cetera, et cetera. The investment committee had already said we want to allocate. The ETF removed the compliance and operational risk in their mind. Now, we could still say there's counterparty risk, but for them, they were comfortable with it, so it became an investment decision. I share this because these are all the gates, and things that could go, like people that could say no to all of this. So what's happening now in DeFi and even on the crypto hedge fund space is everyone starts with returns, saying, here's what you can do, here's the yield, it's risk-free. These are all words that we can believe because we understand the technology. They believe it's a sales pitch, right? So you got to work your way backwards. So fundamentally, you got to go into legacy vehicles in our mind that they understand, with legacy means of diligencing counterparties, diligencing the managers. They want to know who's responsible if something happens. And then at the very end, it's how do I make money on this? Because I trust you, I trust your counterparties, and I know a vehicle that I could write a check into that will meet my bankers, my compliance officer, and legal officer sort of checklist. That's what we're trying to build, but it's legacy ways of thinking, bringing money into the modern age. So then the technology can scale, and then you can get vaults and those things like that. But until then, the capital's not going to come in.
I think these are great points, Pascal. I would add that there seems to be two realities happening, right? Because there's the monolithic, called traditional institutions that come in over time when the right rails are built. And then there is the very fast digital twins that are born from people in DeFi operating because we have an attention span of a goldfish, right? So I wonder the question for Charlie, like on Avalanche as one of the, in my mind, the OG, call it chains that's pushing securitization and security tokens back when it was called security tokens, right? Are you seeing two representations? It's specifically, I think the holy grail is for companies to issue natively on a chain. And yet I'm sure there are other companies, startups that are doing digital twins because it's composable, it's permissionless, right? Do you see that being a fragmented liquidity issue? How do you see those two worlds coexisting?
Okay, a lot to unpack. Is liquidity fragmented? Yes. Will it stay that way? No. But it will take time for those things to come together. And I don't know that I would put it in as stark a terms between the big monolithic institutions and these mirror image DeFi attempts. I view the world as a spectrum. And I think over the course of time, as we on the DeFi, I'm talking about as opposed to the institutional side, as we mature as an industry, you're going to see everything from the most extreme, radical, innovative, small mom and pop idea to something much more akin but tangential to an institution. And there will be this spectrum in terms of how they approach things and how they develop things. One of the interesting things, actually, Rob could talk about this ad nauseum. He's probably seen the best and the worst ideas ever to come across because everybody wants Dragonfly to back them. And I can only imagine that the types of pitches that any institution like Dragonfly sees go from very well thoughtful, established, somewhat larger close to institutional, but not quite ideas to the absolute other end of the spectrum. And I don't believe that what you're going to see is these two worlds existing, institutional and DeFi, in separate worlds in perpetuity, if only because if we don't figure out how to work together and we create this, if we continue to build this sort of fractionalized world, I don't know that DeFi wins that. I think crypto keeps reinventing itself, the different things and the cool things it can do, and the institutions keep trudging along, and the predictions that they would be put to bed a lot sooner than we've been able to do so, I think is evidence of the fact that the onus is still on our side of the ledger to convince the rest of the world that what we're doing that is new, innovative, and exciting is also thoughtful, meets the various different risk parameters, can give investors a confidence that what they're getting involved in is worth getting involved in. So it's up to us to help build the bridge on the sign here between institutional and DeFi. I think we've got to make more of an effort to get to the institutions to convince them that we're solving problems for them and solving problems for their investors rather than just telling them we've got a better way to do this than you do.
I want to talk about something you said there. You talked about a little bit about digital twins versus like primary issuance, right? I'm a firm believer that like the digital twin, I mean, it's useless, right? So like there's a lot of different types of assets are wrappers and they exist in wrappers context, right? An ETF is essentially just a wrapper, right? But when I start to think about, okay, like what is actually happening on chain? Like how do I get like real interest, real liquidity, and net new novel products? I do not think DeFi is going to win because I'm going to take a current product that already exists and I'm going to be able to use, a Chaos Labs Oracle or a, Gauntlet Curator and a Morpho and like, do something programmatically. It's only going to win if it's like a net new novel yield, net new novel product, net new novel derivative, right? Because like that is something that like then people will understand. Now I can do something that is differentiated versus and offer something that's differentiated and it can drive revenue to my business, it can drive returns to my business, right? And so when you look at these, like, I mean, the easiest thing to talk about is the tokenized equity space, right? Like what is happening in tokenized equities today? Well, Robinhood announces they're going to do tokenized equities. Well, what is it really? Well, their US broker dealer buys an equity and then like their EU sub goes and like sells you a derivative off of that US broker dealer backing and you have no rights whatsoever. And like theoretically that derivative does not have to trade or should not trade anywhere in parity with like this thing that exists in this other area. And it's, the same thing that's happening with X stocks, which is even kind of more fucked up. And so like, there's a lot of these products that exist to like narratively say we're doing this thing on chain, but that actually have no real utility for an institution. Right. And I think that's the problem right now.
Well, so I'm in agreement with all this, but again, these firms and these institutions have to tippy toe their way in, and bridging the language is important to get there. So I'm totally in agreement with your vision, but you can't go from here to here without the middle.
Yeah.
You have to build the middle for them to get educated, to build test cases, because at some point, the younger generation who gets this are going to become the decision makers that unlocks the capital. The technology which works today will be integrated seamlessly in user interfaces where the eyeballs are and you can access, and that all of a sudden unlocks liquidity. Until then, I mean, we're just building a vision. That's all we're doing.
Yeah. A couple keywords you gentlemen have pointed out, which is access, right? I think it's a world of competing narratives. And right now for TradFi in front of them, they have primarily access points in ETFs or DATs. So I want to have one last question to Roger before I ask the last question to round out this panel here. As one of the large ETH DATs, how do you think about differentiating the DAT from a narrative perspective against ETFs or other DATs? Are you guys
Hello and welcome to another special segment from Sigma Central Europe Media Lounge. My name is Emanuele Frascadore and today I have the pleasure of speaking with Natalie Östman, partner of Mangosteen Advisory. Natalie, thank you so much for joining us. How are you today?
Thank you. Very good today. Thanks for having me.
Yeah, of
It's been
course.
a very exciting day here.
It's a pleasure
Lots
to
going
hear
on.
that. Yes, definitely. A lot, yeah. Here in Rome, it's always like that.
Yeah.
The worlds of fintech and digital payments are changing fast, especially with the new forms of digital money gaining attention. How do you see these changes influencing the future of finance and the way people and businesses move money?
So first, this shift has been going on for many years. At first, crypto payments were the on the side, not very accepted digital form of money.
Yeah.
People looked at it with a lot of skepticism. And those that were building this, the degens, they were really anarchists in a way. They wanted a new form of banking, new way of doing things. Now things have changed. The benefits of crypto payments have been understood by the traditional world, and new instruments are being developed, new ways of paying, and benefits are coming out of it. So it's becoming mainstream. And that's what I'm really excited about. Regulation has become much more clear about what we can and cannot do. And it's just one of these things that's now taking the industry, the payments industry, the financial industry, all industries, gaming industry, retail industry by storm. It is a new form of how to pay. It gives you a lot of flexibility across the world. It's global. So it's really exciting.
It's really fascinating as well. Thank you for sharing that because I didn't know at all. So it's
There
good
you
to
go.
hear. And what are some of the biggest challenges you see leaders facing today? And what advice would you give them to keep growing sustainably?
Yeah. So the thing that I see the most in my work that I do day to day, it's knowledge. Just like you just said, oh, thank you for teaching me. Well, guess what? All of these industries that have understood the benefits don't have the expertise. And so there's a lot of education that has to happen now. And I spend a lot of my time helping companies understood what the benefits are, understand what's available to them, what the tech stack looks like, what their strategy should look like, who they should be talking to, what the use cases are, how they could use it, how it could benefit their end users. So that, you need to learn, you need to have a vision set forward for you. So there's a lot of that going on right now.
Yeah, that's a really insightful perspective, and I'm sure a lot of people can empathize with what you say.
Yes.
And what is your advice for businesses in terms of turning big ideas into practical actions that make a measurable impact?
Start small. That's my biggest advice. Just go out there and try. Implement something. Test. Teach some of your employees. Get people to learn, to be curious about this. Give it a go, basically, in the English term,
Yeah, definitely.
Try it out. To sit there and wait for some magnanimous impact that's going to be really big is probably not the best way if you don't have that knowledge first. So go ahead, invest in a small department that does things, that teaches your organization internally, and that you as an executive can learn from. And I would say hire some of these, what we call degens, from the crypto natives. Bring them into your organization, have them teach you, have them sit next to you, have them in your board meetings, telling you what's happening in the industry, because there's a lot happening right now and it's moving very fast. So be involved.
Yeah, definitely. So basically, you're saying that bringing ideas to life through clarity and purpose, that's the key.
Yes, 100%. And when we saw this last, we saw it about 20, 25 years ago when this digital payments was happening.
Yeah.
And traditional companies really didn't know how to take advantage of that and what to do with that. And they did the same thing. They were getting what they called then web natives.
Yeah.
And they were bringing them in. Now everybody's a web native. But back then, the executives weren't. And so now you're doing the same with the crypto natives. You're bringing them into the company, and you should definitely try things out.
Amazing. Thank you. And what do you think will shape the next big wave of innovation in fintech and digital business? And where do you see the most exciting opportunities ahead?
So first of all, there needs to be more regulatory clarity in all jurisdictions. What we're seeing right now is that the Europe and the USA have provided regulatory clarity, but a lot of countries like the UK still do not have that clarity on what it means to own crypto, trade crypto. And so we need to have that across the world. We need all countries to tell us what those guardrails are. If we don't know what those guardrails are, we continue to be on the sidelines trying to invent. And as we've seen, when the US became very, very clear with stablecoins, what you can and cannot do, it took off. And then Europe had MiCA, and they've been also taking off. UK has been left behind a little bit. Hopefully they'll come up with something in 2026. Asia also has some regulatory clarity, but again, many countries, many different regions, they need to come up with that. South America as well, a very important market for crypto. Some clarity, but not all countries have that. So again, we need that across the globe.
So basically, technology keeps evolving, but the human touch sort of like has to keep up the pace to lead.
The government's telling us what to do and not do, and what's allowed, is not catching up. But the technology definitely races ahead. And oh, by the way, the longer you wait, the more people are going to do whatever they want, and it'll be harder for you to rein it in.
Definitely.
So yeah,
that's really insightful. Thank you very much. Natalie Östman, partner of Mangosteen Advisory, thank you so much for being with us today, sharing your vision. We're looking forward to the next.
Okay, good afternoon, everyone, and thank you so much for sticking around for this next session. I'm Dan Murphy from CNBC. I'm absolutely thrilled to be here, and I hope you're all enjoying the party so far. We were just talking backstage about how it has been such an interesting week. Actually, I'll double down on that, an interesting year for crypto, and we're going to dive into some of the trends that we're seeing right now. Even by this industry standards, I think we have a lot to talk about right now. First of all, on Monday, Bitcoin whipsawing nearly 8%. We've seen it reclaim around 90,000 USD today, but it's still down almost 30% from its record high in early October. What's also interesting is that around $20 billion in leverage positions have been wiped out in the most recent slide, and some of the market's most important indicators are also flashing some caution right now. You don't need to hear this from me, you know this all already. What's interesting as well is that funding rates in the Bitcoin perpetuals market have also turned negative. Traders moving capital into stable coins rather than aggressively buying some of these dips. Now, against all of that backdrop as well, it's also interesting to see that there is a really strong counter narrative filing out as well. Institutional inflows through ETFs. There's a growing stablecoin economy driving real-world payments. We have a maturing investment ecosystem as well. And jurisdictions like right here in the UAE providing regulatory clarity, even as some other core markets pull back. So to unpack all of this, the volatility, the on-chain signals that we're seeing, the institutional picture, and what the next cycle might actually look like, we have three people who are really shaping the future of this industry from three very different vantage points. So, Richard, I'll kick it off with you. First and foremost, thank you again for pulling us all together, and congratulations on the conference so far. Let's give Richard another round of applause, folks. Walk me through the week that we've seen in crypto, particularly in Bitcoin. What are you seeing in terms of real-world transactions on the platform right now? And is anything you've seen this week giving you cause for concern?
Well, first of all, just let me thank everyone for joining us, including Brad and Lily. Brad flew 20 hours here. Lily was just around the corner, take 20 minutes right here. But regardless, very, very thankful for the support and the love. I see somebody there with a placard stating that Brett is the digital Fed chairman. Where's that? The digital stand up.
And the Queen.
So you can see a lot of support around the arena. Very, very grateful. But as you know, in the last few weeks, right, I think you're talking about volatility. It not only happens to crypto, happens across the different asset class. US equities was impacted as well. The US shutdown and lack of data again contributed to that as well. But we are still very bullish. I think that we share the same view. We're still very, very bullish for the long term. The institutions are coming in a big way, and the allocation is still very small at this juncture, right? So the corporates, the family office, all starting to deploy. And with greater regulatory clarity from the likes of Genius Act, market structure bill in the US, that's forcing all the governments around the world to take notice and to reposition themselves in terms of competitive edge. We think that the best is yet to come, and the momentum is going to be very, very strong.
The best is yet to come. Brad, why do you think the bears are back in the market?
Well, why the bears back in the market? Look, first of all, thank you for having us. I think this is an incredible event. It's my first time to join this event, but hopefully look back to being next year as well. And obviously good to see you both. Look, I think crypto has gone through cycles. And when you have risk on, people are excited. Now you have kind of a risk off moment. There's uncertainty. I personally will echo some of the things Richard said. There are so many macro factors that are continuing to provide tailwinds for this industry that I think as we go into 2026, I don't remember being this optimistic in the last handful of years, where you do have, as Richard said, regulatory clarity in the largest economy in the world. And I think people underprice this. 22% of global GDP is the United States. And this is a market that has been really openly hostile to crypto for 4 or 5 years, or maybe longer. And now you have that has changed significantly pretty quickly, but the institutions are still catching up with that to some degree. You saw Franklin Templeton on stage here. You saw BlackRock on stage. Just this week, I think Vanguard has now opened up. Vanguard historically has said, we won't touch crypto. And now they've had a massive sea change. That's just one of many things that are creating those tailwinds. And so I'm super optimistic about the year ahead. The last thing I'll say on this, which I think we'll also probably all agree about on this, is we are also seeing real world applications where it's not just about the speculation. You're finding easier to use interfaces so that crypto isn't just about the speculation. It's about solving real world problems. And to sustain that long-term optimism, that long-term bull market, I think you're going to see more and more of that.
We're going to talk more about what's happening with institutional adoption, and I'm glad you mentioned it. I want Lily's take on what's happening in the market as well, because Solana has been one of the most aggressively bid up through this most recent upcycle. What are you seeing right now, and are you concerned?
Sure. I've been in this industry for over a decade now, and I think that one of the things that you've got to be able to accept, stomach, and learn how to lean into is the volatility of the markets. When you're dealing with the scope of ambition that we have here in crypto, peer-to-peer electronic cash system, right? Digitizing finance in a way which is accessible to 5.5 billion people. These are exponential outcomes, and you're going to have non-linear ups and non-linear downs. And what has always created this industry is these extremely volatile, irrational markets, frankly, and there are Newtonian laws of markets as well. Irrational up, you're going to have a correction. So I think it's pretty clear to everyone that there was a huge amount of interest driven by DATs. There's DATs for everything, basically from April until about the end of September, and that irrational liquidity window is going to have a correction, and that's exactly what we've seen. And that should not be a surprise. That is not a surprise to many of us. And in fact, having lived through many of these cycles, I remember when $800 Bitcoin was a bubble. And then there was $150 Bitcoin, and of course the world was ending then as well. So I think we're doing just fine at $90,000 Bitcoin.
What's interesting though is that we have seen billions leave some of the largest ETFs in the market too, and there was meant to be this institutional floor under the market as a result of the adoption that we're seeing, but also these new capital flows. It's beyond just the retail investor. Was the ETF moment overhyped, do you think? Lily, take that one.
Well, I will note that actually there is one new ETF on the market that's been seeing daily inflow since it was launched. That is the Solana ETFs. So there's always bright spots in the market that maybe I observe a little bit more closely than others. But there are bright spots in the market. And I would also expect that over this tremendous cycle of where Bitcoin has ascended to these incredible heights, $120,000 Bitcoin, yes, there's going to be a correction. I remember way back when my guest Wi-Fi password was Bitcoin 100K. And I did that back in 2016, and everyone thought it was crazy. And now I have to change my guest password. So,
So what's the password now?
Yeah.
I don't know, what should it be?
250K or?
We'll just keep on adding zeros. So,
Brad, what's your take on this too? Do you think the ETF floor was overhyped?
Definitely no. I mean, look, obviously what you were describing is all data correct, but I think you got to zoom out a little bit further and realize that this ETFs didn't exist because of the regulatory problems in the United States. They didn't exist. And, in the last 2 or 3 weeks, over $700 million have flown into XRP ETFs, which is just it pent up demand from institutional investors, from investors who want access because they don't want to custody themselves, what have you. But look, again, if you zoom out to the macro level, the total ETF market, only 1 or 2% of the total ETF market is crypto. I will bet anybody here that a year from now, that will be more than 1 or 2%. There's going to continue to be inflows. And yes, you could take a snapshot of time and say, okay, there's a billion left Bitcoin ETFs or whatever the data you cited a moment ago. But if you zoom out a little bit further and say, okay, over 2026, do we really think crypto ETFs are only going to be 1 or 2% of the total ETF market? No chance. And so that, again, it's one of those macro tailwinds where Ripple sits in a position where we see, particularly from our Ripple Prime, the prime brokerage business, we see a lot of interesting activity where institutions that have been on the sidelines, maybe because of regulatory clarity, maybe because of risk aversion, for whatever reasons they've been on the sidelines, they're getting involved. And they're starting small, and they're going to walk, then they're going to crawl, then they're going to walk, then they're going to run. And I think it's going to create a lot of tailwind.
So this moment in the market hasn't necessarily spooked institutional capital. That's what you're saying?
Definitely not.
Okay. Richard, you'd agree with that?
No, definitely. So if you look at just data on our platform, right, over the course of last 2 years, which has been exceptional, because you have to remember prior to 2024, it's largely a retail play within crypto. And last 2 years, because of the regulatory clarity that's coming through, US changing from being anti-crypto to now supporting crypto in a very big way with the ETFs coming through, and with financial institutions all starting to embrace and support that. On our platform, we saw doubling of institutional onboarding last year, and again, doubling of this year, right? So they are still coming through in a big way. But as you know, for institutions, corporates, family office, they take a long time to do their own due diligence. The onboarding process is much longer. So they'll come, but it's not going to be all together at one point in time. We're still very early in the process. We're about 8% global crypto adoption. And in our conversation with many corporates, with family offices, it's just a matter of time. They're all going through their own deliberation at this point in time, and they'll be coming on board on that front. So we're bullish for the long term. Again, going back to Brad's point, you have to take a longer term view of things. And there's a saying within crypto, every time if the market is down, every time people say Bitcoin or crypto is dead, if you put money into it, you'll be very, very in a very healthy position now.
What was also interesting through this most recent market turbulence was that even as we saw cryptos falling, money was moving into stablecoins, which suggests that we are also seeing money staying in the system rather than moving elsewhere. Capital has lots of options to move, but instead decided to move into certain stablecoins. So how do you see the stablecoin system evolving over the next few years, and where are we at in terms of maturity right now?
I would say that we're going to continue to see acceleration. So if you look at the market cap of stablecoin, it has grown by 50% this year. The number of wallets, again, grown by 50% this year. And I think more and more institutions, as well as corporates, are realizing that it solves a lot of pain points, going back to Brett, your point. If you look at the current infrastructure in the banking space, right, you want to do a cross-border transfer, you have to go through SWIFT, 1 or 2 correspondent network, take 2 days for the money to be received at very high fees. But if you do via stables and do via crypto, it's instantaneous at a fraction of the cost. There's certainty, right? So if you look at many corporate treasuries around the world, they are moving assets into stable because it allows them to manage their assets and funds on a 24/7 basis, moving from Indonesia to different parts of Europe instantaneously. They can have much greater capital efficiency and velocity on that front. So we're going to see a lot of that. And with clarity coming out from the likes of Genius Act, it gives all the financial institutions pause for thoughts on that front to say, look, this is a much more superior technology, is much cheaper, much faster. So we're going to see a lot of financial institutions issuing it, but also the big e-commerce players, right? So the likes of Amazon, I think they're going to issue their own stablecoins because it's so superior and they can manage their merchants' relationship much better with the likes of stablecoins.
Let me ask you specifically about this as well, because we saw a real-world example of this earlier this year. The MGX investment into Binance, financed using USD1, backed, of course, by World Liberty Financial. What does that unlock?
Well, if you look at MGX, they are AI and financial investor powerhouse on that front. They fully realize the power of digital money and digital future together. So they have picked a stable coin in terms of the mode of payment, and we welcome that. We are crypto native and digital native, and so it's a much more efficient way of movement of money compared to the traditional fiat rails. And we host tables on our platform to satisfy user needs as well. And I mean, even with our regulated entities globally, with regulators, we highlighted to them the use case, the importance of it, and why this is much more superior in terms of even holding our regulatory capital in terms of stable coins instead of putting them in banks.
Raised some eyebrows though, didn't it? Were you surprised by the reaction?
Well, a lot of them still have a lack of understanding of the pros, the benefits, how it works, etc. So it's an educational process, even with the regulators around the world.
Brad, can you talk a little bit more about the institutional adoption here and what you're seeing in terms of real world payments as well on the stablecoin side?
Well, I mean, the stablecoin point you're making particularly, I think you are absolutely right that as people kind of went risk off, they stayed on stablecoins, which is indicative of, as Rich was describing, the utility, the 24/7 nature of a stablecoin, but it's also trust, where maybe years ago they might have said, I want to get into a fiat that I trust even more, but people are recognizing that stablecoins can be stable and easier to manage. But look, this region in particular leaned into regulatory clarity early. Ripple launched a stablecoin just over a year ago. It's just passed about $1 billion market cap, but now it's also been approved in whitelisted in Abu Dhabi as well as in Dubai and the DIFC. It's good collateral on various platforms from a lending point of view. And I think that the tailwinds just on solving real problems and good collateral that's easy to move and is more flexible and can be moved multiple times a day even, that wasn't possible before. And I think we're going to see a lot of unlocks that, when Ripple thinks about this, and it's an honor to be up here with these two, we want Solana to do great. We want Binance to do great, because I think we're still bringing people into the ecosystem. Stablecoins are one way of doing that. There are going to be lots of other applications, some that Ripple builds, some that are built in the Solana ecosystem, and some that Binance builds.
Lily, what's your message to traditional finance here and people like Jamie Dimon who have gone from rat poison to pet rock on this?
Well,
is he still at Pet Rock? I thought he actually came further than that.
He did come further than that. I think it was around 2017. It was rat poison. Warren Buffett as well, so he was in good company. And then 2021, we got a Pet Rock, sort of moving up in the world. And I remember when IBIT launched, then Jamie upgraded his opinion of the ecosystem into my daughter owns Bitcoin. So I think that when you're building these disruptive technologies, then there's always this competitive as well as cooperative relationship that you have with institutions, which itself is not monolithic by any stretch of the imagination. And so there are areas that we very collaborative with institutions. I think the most collaborative is on asset issuance. The way institutions see that is, well, this is new distribution to obviously a very wealthy group of folks. I can now distribute my money market fund, my private credit fund, and as folks that primarily monetize AUM, the value proposition for that is very clear. And there's also value proposition for institutions around much more transparent back-end usage of blockchains. And that's where if you think about it just very pragmatically, your $100 million a year of tech R&D spend can go down by however much. That's pure sort of bottom line contribution. So I think those are some very real reasons. And those, I think, when you're actually in these conversations, that's really the focus of how people are thinking about working together. And we'll leave the rhetoric for some fun forums.
Let's talk about how you intend on growing each of your respective businesses from here as well. And Lily, I'll start with you, because you also said recently that speed and low fees aren't necessarily going to be enough to bring the next generation of users into the ecosystem, even into crypto in particular. So what would you say is missing, and what responsibility does Solana have here as one of the fastest growing networks in building the infrastructure that will be required to facilitate this development into the future?
Sure. I think that for me, I try to remind myself going back to basics. Actually, I recommend every so often just to go read some of the original Bitcoin talk forums. A lot of clarity of thinking. All of the use cases have been discussed, outlined more than 10 years ago. And I think that ultimately, outside of digital gold, all of the others, every single thing that people are trying to build, programmable blockchain, so on and so forth, is no longer digital gold, the digital asset side of things. Only Bitcoin gets to be that. Everyone else is trying to be the native financial infrastructure of the internet. That infrastructure accessible to 5.5 billion people, and fundamentally, we are tech for finance. Not tech for tech, not tech just for developers. That's part of it, but that's not the end goal. This is tech for finance. And so if you think about what does finance need, there's just some really basic core requirements that financial systems, financial markets require. Speed and cost is table stakes. Programmability is the whole arc of 2015 up until now. That's obviously very important. There's a well-proven thesis around why tech platforms that enable developers and enable applications and broadening the utility around something, in this case around money, is fundamentally useful. And I think that also liquidity, of course, liquidity is king. So if we were to boil it down, it's really around speed and cost, liquidity and utility, and putting all those things in the same place. It's not actually that complicated at the end of the day. And that's one of the things that we've architected Solana for at the very beginning, which is why Solana was heretical at the very beginning, not to have L2s, not to have shards, not to have sub chains or anything like that. Because I think that's always been the vision. Clarity, this is tech for finance, and that's what markets need.
What's the North Star for Solana then? Do you have an end goal?
I think Bitcoin articulated it for all of us, the peer-to-peer electronic cash system. Bitcoin presented sort of the first part of that, this blockchain architecture. But the question has always been, is it possible to build this sort of TCP/IP for money? People have characterized this so many times over the last 18 years. But is it possible to build that sort of native financial infrastructure for the internet? So we digitize all content practically. And if you think about assets, if all assets become tokens, you basically digitized all assets into financial content. Is that possible? And then create this sort of unified infrastructure and also therefore unified liquidity and sort of unification of applications to bring maximum utility to money and also to make that accessible to not just all users, but also the part about financial inclusion that few people talk about is also inclusion of issuers. And the inclusion of issuers to be able to access global capital markets from wherever you are, that you don't have to go wrap yourself in a corporate structure between Hong Kong and Bermuda or BVI and whatever it is into New York and go pay $15 million of lawyers' fees and banker fees in order to after 10 years of being in the trenches to be able to have access to global liquidity. So, to me, the inclusion story here is not just on, let's call it the retail side with the unbanked around the world. That story is very relevant and has been discussed a lot, but it's also around the supply side in global capital markets. But ultimately there's infinite ways to think about why unifying the utility and really the assets and liquidity of 5.5 billion people is interesting and useful.
And it's interesting as well because we talk about this on CNBC all the time, but we're essentially seeing the rewiring, the replumbing of the global financial system in real time, and each of your businesses has a role to play in that as well. Richard, I wanted to come back over to you because under your leadership, we've also seen Binance expanding quite significantly. What is the next big growth market for you? Because you're also pushing into licensed markets in particular, helping to develop regulation in some of the markets where you're operating too. So where to next?
Well, there are so many bright spots, right? So we deploy internationally. By today, we have close to 300 million users. Our ambition is to bring in the next 1 billion users into crypto industry, and we are all working together on that front. But if you look at it, there are many bright spots around the world. Latin America is moving very, very fast. Different parts of Asia Pacific, this region, Middle East, again, is growing very quickly. But in terms of rules and regulations, they are still not uniform throughout the world. There's a lot of harmonization that needs to be done, and many countries have still not developed their framework. Just now, I was just talking to a user from a different country to say, hey, my friend wants to buy a million in Bitcoin and finds it very difficult because in that country, they still experience the banking issue, right? And there are still too many hurdles, right? So how do we work with global governments around the world, policymakers around the world, to remove all these unfair hurdles that's imposed on crypto, that's not imposed on any other sector, including the banking sector, right? So the more we can work together on that front to bring in a uniform set of standards, to remove the debanking issue, to remove the hurdles, you are going to bring in a lot more people into the industry. And by industry partners working together to really embrace crypto adoption, deployment, building the use cases together, which is extremely important, bring across much better education for the masses of what this technology stands for and how it changes the lives of so many people around the world. I think those will be very important for us to continue to grow.
There's going to be a new leadership structure at Binance as well. I'm wondering if you could maybe take us inside what that change is ultimately going to mean. And as an extension to that, I have to ask you as well, do you think President Trump's pardon of CZ has made it harder to demonstrate that Binance has changed?
No, so if you look at it, right, so we have made some missteps in the past, in the very early days, but really the landscape then was totally different, right? Even today, the rules and regulations are just still developing, still quite nascent. The US again went from empty crypto to now providing clarity in terms of rules. But if you think about many other places in the world, they are still not giving that clarity in that space, right? So in the early days, we make some missteps, but as with all responsible entity, we acknowledge them, make amends, and invest greatly into the areas of compliance. So by now, we are the most regulated entity globally with 21 different jurisdictions spanning the globe in terms of different areas. And we will continue to invest very greatly into the areas of compliance. So if you look at our compliance headcount, it accounts for 22% of our global headcount. So about 1,300 people in compliance working across the globe to make sure that we uphold high standards. Compliance spend goes up 30% year on year for the last 2 to 3 years. And this is an area that we will continue to invest quite greatly in. So today we are very, very excited to announce a new leadership structure with He as co-CEO. And He is not unfamiliar to many people within the crypto and Binance infrastructure and ecosystem, right? She's a co-founder. She has been there from the start, and she has been driving a
Alrighty, that is it for today's live stream, everybody. Don't forget that if you are tuning in here for the first time inside the CyberX research channel, throughout the week as I continue my travels for the holidays, I'll start these lives for you all in my spare time, going over just some of the videos, the panel discussions, everything that we have inside the private CyberX research channel. There is a whole slew of crypto Web3 related research where inside the CyberX research team goes into deep dives into blockchain, Web3, DeFi trends, geopolitics affecting global markets. There's fundamental breakdowns inside our Discord, strategic perspectives that are aimed at keeping our audience ahead of the game. I cannot stress enough that now is the time to be focused on real research, real fundamentals, no hopium, no hype inside our Discord. Come and check it out. Head over to cyberxtrading.com. We'd love to have you inside the team. As always, many blessings to you guys. Be cognizant, be aware out there. I will see you all in the next live stream sometime later this week. Everybody, happy holidays, and I'll see you guys in the next one.